This material is provided for general information available from sources generally available to the public and is not a personal recommendation. As always, past performance is no guide for future returns. The value of your investments can go down as well as up, so you could get back less than you invest.
Hello and welcome to the market update for the 4th of August 2021. For the observant clients out there, you'll notice this isn't Chris Brewer this week. Chris is on holiday. This week, the update will come from myself, Mike Whedon, I'm one of the advisors here, and Matthew Sinclair, who is also an advisor here. In this update, we're going to discuss the key headlines in the UK and the US and discuss how economies have continued to recover well following the COVID pandemic. So in April 2020, furlough was introduced, a word that was, new to us all. However, 18 months down the line, there's been continuous furlough throughout the UK. And on the 1st of August this month, the furlough scheme has changed again, with the employer contributions now increasing up to 20%. The scheme will come to an end in September of this year, with things reverting to normal from the 1st of October. When the scheme was first launched, one of the fears was that when furlough began, following this scheme, redundancies would just be masked and happen towards the end of that. However, we've looked at some figures, and in January 2021, furlough workers peaked at 5.1 million. As we stand here today, this is now down to 1.9 million. So if we look at the unemployment figures over recent times, we can see that obviously some of the furlough workers may still face redundancy. However, the positive is that we can see the unemployment figures has continued to fall, despite us knowing that there's over 3 million workers that are no longer on furlough. This really goes to show what a great effort the government have done and how furlough is working towards minimising job losses, and that the end result has been it's nowhere near as first feared. When we look at inflation, we have a very service-based economy in the UK. UK inflation rose to 2.5% in June of this year. If you look at the graph, you can see that the leisure and the retail sectors have contributed to the most of this, and the economy has continued to reopen. There's almost 70% of the UK now fully vaccinated, and the opening up of the economy continues to advance week on week. In the UK housing market, the stamp duty holiday is being phased away and will come to an end on the 1st of October 2021. However, Zoopla and Nationwide have anticipated there will be strong UK demand in the housing market well into 2022 and beyond. As you can see, the UK housing market has grown over 10% over the last year. To put this into perspective, this is the fastest rise in UK house prices since 2008. Stamp duties have played their role here in keeping the housing market strong. When we look at UK dividends in 2020, early 2020 in March, the Bank of England forced banks to cancel dividends. This was to ensure that they could weather the storm of COVID and keep liquidity there. Recently, the Bank of England has lifted all restrictions on UK bank dividends. Authorities are increasingly optimistic of the economic outlook going forward, which is great because financials, oil and mining sectors make up a large proportion of the UK stock market. There's 7.2 billion of dividends and share buybacks announced by UK companies at the end of July 2021. We really believe this increase in the UK dividends is positive news for UK markets, as it shows a strong recovery in company earnings. I'll now pass you over to Matthew Sinclair, who'll be doing the US market update.
Any regular listeners will know from Chris's updates that companies like Apple, Microsoft, Alphabet and Amazon have continued to perform well during COVID, and it'll be no surprise therefore that US company profits have beat expectation over the last year, on average rising 86%. This is the highest growth that we've seen for US companies since the global financial crisis in 2009. As you might expect, volatility still remains quite high because of the coronavirus and the worries of the Delta variant. However, one of the headlines that we've seen recently is that the S&P 500 has now risen for the 6th straight month as markets continue their strong recovery. This is the best monthly streak since 2018. US Federal Reserves are likely to keep their interest rates near zero. The main reason they want to do this is they don't want to see unemployment rates to rise. As you can see from this graph, The normal rate of unemployment has been around 4%. There's been a big impact by coronavirus. We've had highs of around 14%, and they've started to come down steadily, which is encouraging for the markets. But as you can see, they're not yet at that sort of normal level of 4%. And for that reason, we'd expect to see interest rates continuing low. As you can see from this graph, which looks at 2 US indices and the FTSE 100, the graph shows that the markets have performed strongly over the past year. We recently spoke with HSBC Global Asset Management, and they anticipate that equity returns to slow slightly towards the end of 2021, but they're still expecting a positive return. As you can see from that chart, the overall trend is quite consistently positive, but as you can imagine with what's happened in the last year, if you were to zoom in on any section of that chart, you would see the individual volatility. This is naturally due to the speed of the global recovery so far and not something we're concerned about. As you can see from this 5-year chart, the equity markets have recovered well. The blue line, which is the FTSE 100, has now come up to levels that we saw before COVID-19. When we construct the equity content of our client portfolios, we invest into equities across the world and don't focus on just one area. This diversification helps to improve the portfolio performance and also helps to manage risk. So that concludes our latest update. Thank you very much for listening. We hope you found it interesting, and as always, if you've got any comments or any questions that you'd like us to address, please get in touch. Thank you very much.